I'm heading up a retail investment at Colliers in the CE region, basically specializing in retail investment. I spent for 20 years at IKEA Group, and since like 2.5 years doing the investment at Colliers. So that's pretty much it.
Great, Herman.
Herman Kok, heading the research department at MeyerBergman in London. MeyerBergman, investment and asset management company established in 2004. And we have a strong focus on urban mixed use, particularly high street retail with other functions on top of it, as well as we are looking into last mile logistics.
Great, thanks. Vanessa.
Vanessa Gelado, I'm investment director at NEINVER. We are an investment, asset management and development company focused right now on the retail and the logistics sectors.
Great, Edgar.
My name is Edgar Hertog. I'm director of investment of Savills Investment Management. Savills Investment Management had around 18 billion assets under management, of which 5 billion of retail. So retail is quite important for us. We have a very big retail team. And, well, we're looking forward to 2019.
Why don't we pick up with you, Herman, first of all. You're coming obviously from the research side as well and the strategic side. Retail's been performing well in Europe, and we're also now seeing economic growth. So how do you see, I suppose, the macro influences on the sector?
Well, of course, in general, the macro conditions these days are favorable. Of course, we have to see where it's heading to. When we see it, look at the newspaper, you know, there is a little bit hesitation. Are we going to see a soft recession, yes or no? So the future is, let's say, less bright than what we are used to. On the other hand, the outlook doesn't look too bad either. Strong macroeconomic fundamentals, but I think in general in Europe a problem, much more a problem in the US, is that in major part of the countries, in a lot of markets, actually the economic growth hasn't been really leaking through to the middle classes. I think that's the main issue when we look in the United States, for instance. Also in the UK, we see it in a lesser degree in the Netherlands. We have had a period of about 4 years of economic growth, and at the same time, when we look at the statistics, we actually see the number of low-income households increasing. So there is a problem in terms of spending power, and of course for retail traditionally relying on mass markets, on mainstream, on, let's say, the middle class. Of course, as long as that middle class doesn't really grow, and that's what we see happening in some countries, actually the recovery in the retail stays behind the overall economic growth. I would say in the US that's relatively dramatic. If that's one of the main drivers why particularly the mainstream retail is having troubles. We see the same patterns also in the UK and in lesser degree on the continent. And of course connected to that, or let's say very disruptive, of course, the online trade, simply retail transforming from a pure physical business to a multi-channel business in which the stores is just one of the channels through which turnover is being made, through which transactions are being made. Of course, the retail landscape is adapting rapidly. We see that location patterns are changing. We see that store networks are changing. So obviously, these two factors together, for, let's say, real estate owners, that's something we have to be very much focused on. What are the fundamentals? How are the fundamentals changing? Which locations do we want to be today, and which locations do we want to be tomorrow?
Okay, good. Edgar, let's pick up a little bit on that. You're at the moment quite, as a house, as Savills Investment Management, have been quite active in terms of investment when some people have been holding back from investing in shopping and retail particularly. What's leading to that investment strategy, I suppose, and where do you see us in the cycle in Europe?
Yeah, the strategy leads also through the client, so it depends on the client who is going to buy. We have several funds, mainly retail funds, and they are buying at the moment, but be fair, we used to buy a lot of high street properties, and you see nowadays that it's getting more tough to buy these at normal yields, because yields are dropping down if you're going to the big city centers like London, Hamburg, Paris. So we're going to move over to the other cities, particularly in countries like France and Netherlands. And also we're changing our strategy also mainly to food-anchored stores. Because from the investor outlook is that they are looking more at a secure income. From the food anchored stores, it's like you have a 15 years lease. So it's more, it's changing. So it used to be really focusing on shopping centers and now aiming more at factory outlet, food anchored stores, and some small convenience stores in around the cities.
Okay, good. And let's pick that up with you, Vanessa, because obviously NEINVER are very active in the outlet sector. I suppose if we imagine ourselves that we were sitting here 12 months ago at MAPIC, what do you see, I suppose, as the biggest changes that you've seen over this year? How do you see the market heading?
Well, I think the outlet sector was extremely resilient during the recession. And after, coming out of the recession showed amazing growth in terms of sales. So picking on that, we saw a lot of new investors coming into what's really a niche sector within the industry. So a lot of competition, which of course resulted into a very strong compression in yields, and we were talking about this before, where the yields have been converging to shopping center yields, and in some cases even beyond that. I think 2015 between 2015 and 17, there was a very strong investment market in the outlet sector. I think 2018 has been a pause, definitely at least at the more specialist level in the European landscape. And I also have very strong expectations for 2019, because I think there should be a pickup after the lull, the little lull of 2018.
Okay, good. And Dariusz, obviously you're based out of Warsaw, very focused on the Polish market, and we always like in these to be able to have an overview of a number of different countries from pan-European, but also then be able to drill down a little bit into a different market. And CEE has obviously had much more significant GDP growth than a lot of Western Europe or the UK, for example. That should generally feed into money into people's pockets and therefore a higher retail spend. What's your sense of particularly the Polish market? Are you still seeing growth there? How much is this GDP growth beginning to influence, I suppose, the retail side?
Actually, I can comment on the whole CE market, because basically we do have a huge interest of modern retail space in the CE region. And actually to what you said about the high street locations, the convenience shopping centers, or a single tenant triple net lease agreements with, doesn't matter actually who it is, if it's a DIY store or a supermarket, this became really on top of the investment list for basically all investment funds. Even though US funds are not really in favor of retail in Europe, they do buy these triple net lease agreements, and this became really a trendy product, I would say, like retail parks in Germany years back. Unfortunately, in the CE region, we don't have that much high street locations or opportunities. Prague became extremely expensive now, and I think you agree. So it's kind of buying in London or Prague, it's more or less same price tag you need to pay, and it's difficult to get an asset. In Poland, basically high street doesn't exist. So what investors do is basically they need to buy a shopping center and invest if they're interested in retail. The problem is actually that since, I would say, 12 months, we have a huge difference between prime and dominant shopping centers and everything else. For top shopping centers, in every case, there is a relatively long list of investors, and despite of the size ticket. Why in the secondary cities, if the shopping center is not dominant, it's actually difficult to get any, in many cases. And it's not even about, the people used to collect rent rolls and information about assets. I think this has changed, that people actually don't really need this information. So, Poland and CE is really, really active, especially Poland. Most of the investors actually look on Poland as something to to start with. And it's going to be another record year, but then not many people actually go into details and check why it's a record year. So let's hope. Next year it seems to be also quite good because of majorly some portfolios for sale.
Okay, good. And Vanessa, I know that you guys have got development in the pipeline in Poland. What made you, I suppose let's pick up a little bit on what makes it an interesting investment for you when you're looking to develop a particular area. What are the things that you need to tick all of the boxes for you to think, that's great, that's a great location, I'm going to go there, and then we can see whether Poland has that?
So actually, well, we are doing two developments. One is actually in Amsterdam, in the Netherlands, and the other one, we are doing the pre-development work in France, like close to Switzerland. But we are looking at acquiring something in Poland right now. In terms of development, paramount for us is the catchment. And it's in terms of number of people and also the purchasing power that we were alluding to before. And it's important for us to understand as well the tourism potential, the potential for day trippers coming from surrounding areas. So that's really key for us. Right now, in terms of the Amsterdam project, we are going to be located between the Amsterdam city center and the city of Haarlem, very close as well to the airport, and we have a direct public transport connection to the Amsterdam city center. So we are very much looking forward to finalizing the construction on that and opening. And then in terms of our French project, this one sits in the French area, but actually is looking to capture the Swiss, or actually goes into the Geneva Swiss catchment. And this is actually, we've done this already in other projects which we had close to borders. It does require specific know-how because you do have to be able to cater to two very different countries and consumers and ways of doing things. But at the same time, you also benefit, for example, from being able to draw people in different bank holidays and different holiday seasons. So there's a strong benefit to the to a cross-border project in that sense.
Okay, good. And Edgar, have you mainly, in terms of your investment, mainly been buying new developments, or are you looking more at refurbishment, or where are the opportunities that you're seeing particularly?
Well, it's not particularly. We're looking at, it's the same what we said before. We're looking at opportunities mainly driven by good purchase power, driven by good tourism, and driven also by yields, of course. So if it's going to be newly built or redevelopment, it's for us, well, not very important. For us, it's important that it is a scheme or a center that will be a liquidity of the couple of years. So if it's, well, you could buy, for example, some newly built centers, of course. But overall, there's always a problem with those new centers. We don't know anything about trading history. And there was, for example, a couple of months ago, a really big center in the Netherlands, which was being marketed by ASR. And the problem was that they're very nice tenants into it, long leases, food-anchored stores. But there was nobody who was interested. And the reason why was because of the lacking of information of trading history. And that's the reason where, if we're going to acquire, we need to look at the environmental and purchase power, but mainly it has to have some story behind, because otherwise we're not doing it.
Okay, good. Herman, I wanted to touch on a little bit, we discussed a little bit there the difference between the prime yields and the secondary yields. When I'm looking at it across Europe, you're seeing prime yields pretty much staying where they are, and certainly the owners saying that footfall is still good and spending is still good in those. And then you've got the yields moving out quite significantly as soon as you move to secondary, which interestingly is the absolute reverse of what's happening across Europe in terms of the office sector. Do you think that people are focusing on office and forgetting retail, and that this is actually a hidden opportunity? Or do you think there is something structural that's happening there, which means that some of these assets will need to be repositioned? Do you think the rest of the market is missing a trick?
Well, I mean, when you look to the investment volumes, and you look, let's say, at the investment reports of the last quarters and during 2018, obviously retail is down, but most of the other sectors are down as well. What, of course, we see in retail, there's a lot of discussion, and the discussion, of course, is a lot influenced about retail trends also in the United States, which, as mentioned before, are more extreme than what we see in Europe. But obviously, because of what's happening in the market, administrations in the UK, of course, the whole middle class issue in certain markets, the whole impact, the disruptions of online sales, retailers becoming multi-channel, there is obviously a lot of uncertainty in the market, where is the landscape going to? And, I have to admit also, we as an investment company, we are really discussing almost on a daily basis, what is the landscape going to look like in the future? And of course, in that sense, in terms of, let's say, risk management, you want to preferably bet on safe bets. So I can imagine, of course, fundamentals, prime yields, large shopping centers, dominant locations, well perceived, popular, and of course, wherever there is things unclear, is, for instance, the department store going to stay as anchor in that shopping center? Will possibly, for instance, Marks and Spencer give up that high street area? Where there is a lot of doubt, of, let's say, question marks on what's going to be the dynamics in the tenant landscape, obviously investors will become more cautious. Because in a lot of centers, in a lot of context, a tenant leaving is not a guarantee that with the next tenant you will get the same rent. So also when we look at our ambition in Europe, we are not that much looking to markets, to countries, but what you also mentioned before, we are basically looking to areas where there is volume, areas where there is growth. So obviously we like the large cities, we like the core cities, we like the capital cities. So coming back to your prime yield, obviously many investors like them, so obviously already in the higher ranges in the market, we are looking for certainty. Within those cities, we are looking for areas, locations where there is growth. Because on the one hand, people say there are too many locations. On the other hand, when you look around in many large cities, actually you see new locations popping up. How can that be? We think we have too many locations, at the same time we see new locations coming up. So the landscape, from a fundamental point of view, is changing. In terms of new urban quarters, in terms of neighborhoods, in terms of new business areas, mobility patterns, public transport, etc., etc. And of course, getting to those locations, finding the spots where it's happening or where it will happen in the coming years. And of course, many people are doing that. So there you see obviously an upward price pressure to have the chance to be there. And in a lot of other locations where, let's say, there is uncertainty, particularly in these days, expensive real estate, big risks, people will be cautious. So you see the secondary yields in that sense shifting away, because of course also secondary yields are very heterogeneous. The prime yields are always the very best. What is secondary? A good secondary, modest secondary? Do we have bad secondary? Nobody knows. So secondary, it's widening. It's almost like a funnel.
Dariusz, I just want to pick up the point with you. I mean, it's been very interesting in the discussions we've had over the last 12 to 24 months, seeing how much things like livability, walkability, happiness, well-being have come into discussions about all kinds of investment things where genuinely, I think, 2 years ago, 3 years ago, people would have just told me I was being mad if I was asking those questions. What's your sense about that, particularly in the CEE? Because there's, I guess, more development opportunities in your region than there is in the other parts of Europe. How important is that for investors or developers when they're looking at a location and looking at a scheme?
It's a big difference between developers and investors, actually, because developers want to develop, investors actually just look at the Excel file. So it's difficult actually to convince them that they have to invest in the leisure and entertainment component, because it's very hard to convert into the higher NOI and actually value of the shopping center. Actually, you also mentioned about the KPIs and what investors are looking at. I mean, the history. The most important thing to check nowadays is the footfall. And in the past, it was the turnover per square meter. And now less and less people care about it, because if you have e-commerce, I mean, what does it say is that the turnover if you can't see it, basically, yeah, or if you have figures from 40% of your GLA. The footfall is the driver, and it's a major indicator for the valuation of every big shopping center. So despite of the convenience shopping center, retail parks and or high street locations, basically every shopping center, it's like what you do with the outlets, is the footfall, and based on the footfall, people will actually justify how much they can pay, and that's what is happening with Microsoft, Apple, Samsung, all those guys actually, that they want to just increase the brand awareness, and they're willing to pay decent rent based on your footfall. The problem is actually that we talk about leisure since now quite few years, but if you look through the whole Europe, basically, you have very few developments which are actually doing that. And that's it. I think it's very difficult for the landlords to sacrifice 30% of the GLA and convert, 20 or 25 euro per square meter that generates a regular fashion tenant into the leisure component that will actually cost you a lot of money and will bring you people, but not really your NOI in the first stage. And I think, we have great examples like what Unibail-Rodamco is doing globally with the new projects. Actually, they ask a question how the shopping center should look in 2050 or 2035 if they are opening in 2025. And it's quite interesting actually to see what they plan, what they have in mind. Of course, they're one of the biggest in the world, so it's relatively easier for them to talk. But I think many shopping centers will suffer because it's only Excel behind it.
Okay, good. I'd like to explore a little bit the outlet centres. Picking up that point about F&B experience, those kinds of things that weren't really the focus either of shopping centre owners or investors. Is that something where that you're also having to focus on in terms of NEINVER when you're creating a centre or refreshing a centre? How much are you trying to, I suppose, second guess what the consumers are looking for, what they need in a centre, and build that in?
Well, I guess and just looking at our more most recent developments, so the amount of GLA that we are dedicating to F&B, for example, is definitely on the rise. So it used to be maybe just a 2% or 3% of GLA, and now definitely it's moving up towards creeping up towards the 5 or the 6%. At the end of the day, if you think of it, when people come to outlets, the dwell time is typically long. So people will need to eat something at some point, and you need to be clever about where you put the F&B and being able to cater to for the different needs throughout the day. Also, if you look at our latest developments, we are also dedicating more and more space to a VIP area, to a kids lounge, to also thinking about the experience and having concierge services and so on. So it's definitely as well something which we are becoming very keen on in the outlet space, because it's true that our value proposition is great brands at a nice discount. So there's a big price component in what we offer. But with what the full price sector is being obliged to do just because of the competition from the online channel, we also have to react, and we also have to be on our feet, and definitely we are having to move into the leisure and the F&B space.
Okay, good. And Edgar, in terms of, Vanessa there mentioned e-commerce, and we mentioned it a little bit earlier as well. What's your just your overall sense of that? Do you think that, e-commerce, interestingly, in the UK is still going up, but now actually it's not going up as steeply as it was, so the curve is beginning to get less. It's obviously growing, it's still at a growing phase, particularly as well in Europe. But do you see this just being part of a structural change where maybe formats will change. I mean, I'm always interested when I hear the death of retail, because I remember people talking about the death of office as soon as we had broadband. And what have we got? We've got in London 90% of offices we work, which is people pretending to be working from home but actually working in an office. So do I believe that people will wear virtual reality headsets and buy clothes with it? I don't know. It doesn't appeal to me, I have to say. So what's your sense of, I suppose, that future perspective, how much of a role e-commerce will play, or whether it'll bring actually new brands into physical stores? How do you see that for the shopping centre side?
No, shopping centers, I'm not sure particularly on this one, but if you're looking to retailers, the omni-channel retailers who are using the omni-channel, they're doing okay at the moment. And you see some retailers are starting up those omni-channels, and I think they're too late. On the other hand, if you're looking to, for example, food anchored stores like supermarket, and you're looking at e-commerce, I don't think there's going to be success because the costs are way too high to achieve these e-tailing. So what we see at the moment is that food anchored stores are getting much more important. You see those regions are getting smaller. So for example, you have several countries now, and we're looking mainly at urban cities, that it could be that you have 4 or 5 supermarkets in an area of no more than 10,000 people, which will do. And that's a different one if you're looking to the fashion retailers, because if you're looking to fashion retailers, it's even happening at the moment in some countries when stores are closed, that it will suffer on the e-tailing as well.
Concepts and formats will change all the time. When I was a small boy in the Netherlands, a good-sized supermarket was like, 700, 800 square meters. Now it's about 2,000 square meters. About 10 years ago, a hypermarket could not be big enough. Now we don't know how to shred square meters from hypermarkets, simply because hypermarket operators are leaving the non-food as specialized retailers. Online, e-commerce are much stronger. IKEA is moving into the city. And I think, those are just a few examples, but wherever we look, and that can deal with the societal changes, it can deal with changing mobility patterns, it can deal with online, it can deal with preferences, etc. But formats and concepts are always changing. We see now in the food, experience is becoming more important. Now, if such a factor pops up, for instance, a small example that Lidl decides to include a small bakery in their discount supermarkets. That has an impact on the size of the store. That has an impact on the concept. And those kind of things are happening as long, as I know retail, also in the history. And of course, our task as real estate owners is we have to be able to facilitate those changes. If you have a large hypermarket and the hypermarket downsizes, and it's designed in such a way that you cannot bring an alternative use in that hypermarket, then I think there is a big problem in that project. There is a big problem in the design. And as an investor, as a landlord, you have to anticipate on that kind of things.
Okay, so you're actively anticipating, you as well, in terms of potential for change of use if something goes wrong with the asset.
Yeah, exactly. On the other hand, you have to be sure on planning consult, because in some countries it's easier to change the zoning than, for example, in other countries. I think in Germany it is easier to change and to get another supermarket next to it. Reason why we're very cautious to buy and invest in these kind of centers, and particularly we're going to countries like Italy, Netherlands, Poland, where it's slightly difficult to change this, because it's protecting those cities and they are protecting the centers as well.
And is your sense, Dariusz, I mean, I know there are specific things within the Polish market about Sunday trading and those kinds of things, but in terms of regulated growth, just like Edgar is saying there, in terms of in general, whether it's local government or main government, the regulatory environment, is that therefore safer for investors to be able to look there? And how does that differ when we're looking at the CEE regions in terms of that regulation over development and planning?
How I can comment? 2 years ago, during Expo, every of my meeting, I started with a question from the investor, actually, what is happening in Poland? But since 1.5 years, basically all European countries have some kind of difficulties on the governmental level, so nobody cares anymore what is happening. Nothing bad has happened in Poland. And basically you can see that the investment volume is growing year after year, since 2016, we have, now we actually gonna, in the end of third quarter, we already passed the total investment volume from 2017. And, people might comment what is happening actually with the government, but actually, Germans, English, Italians, we all have something. And basically, I'm not getting any more questions about it. Really, what I need to explain more is, like, for instance, when I for instance, today I met several of those big food operators with the hypermarkets. Actually, what they think is, I asked them, do you really make money on e-commerce? They said, no, but we have to have it. They actually are losing money, and therefore, if you see what Carrefour is doing across Europe, actually they're changing the merchandising look and platform for how the Carrefour looks like. It's not that they're downsizing; it's that they put McDonald's inside, at the coffee shop or whatever, and the store looks totally different than it was, 2 or 5 years ago. And I think the rest will have to follow, or we will have a new players. Simply as that.
Okay, good. Vanessa, you wanted to pick that up.
Yes, I also want to say it's true that in Poland, and we have a portfolio of assets in Poland, and I think one of the things that we definitely didn't like this year was the Sunday trading ban, which we never thought would be approved, and then it suddenly was. But it's true, as Dariusz was saying, that the political landscape is in a bit of a turmoil, and it is impacting our other jurisdictions. So, for example, there are already talks in Italy to do something very similar to what's just happened in Poland, and I think that's it, as investors and as landlords, it's the worst thing that can happen to you, to invest into an asset or into a country and then have the rules of the game change just right way through the game, right? But it's probably part of what we're going to have to deal with, as you say, and then this is partly because the economic benefits of the cycle are not getting to the middle classes, and so there's a lot of people which are upset and are expressing it in the way they vote, right?
I just want to comment the Sunday ban for retail. Basically, people love to talk about the Sunday ban, but actually I have not seen a single financial model showing that actually the devaluation of the shopping center was lower than before. But actually we really affect the valuation of every shopping center is basically e-commerce, because people actually they try to calculate how this will really affect the tenants. Because the Sunday ban, it will take another 3 years until everybody got used to it, but e-commerce will stay, and that's what will really affect the investment market.
I think that the unlucky side of it is that it is discriminating between the physical and the digital, because the physical won't be able to trade on Sundays, but the online is going to be open 7 days a week, 24 hours a day, which is really hard for the landlords in that sense. And it's true that the consumer will adapt, and we've already seen throughout the year there was a lot of confusion in the first few months, and the consumer is now rapidly adapting their purchasing habits. But it's we're still not seeing maybe an impact in valuations because the valuers still don't have the data. Valuers are always behind the curve a number of months, because they need the data to be able to deal with it, to be able to translate it into the valuation. So I think it still remains to be seen what's going to happen, really.
Okay, good. Herman, you wanted to pick that up.
Well, on the regulation, and first of all, of course, opening hours. I mean, if you close shops while the e-shop is open, then of course, the clients will follow another channel. But what you were touching on, I found very interesting on the regulation in combination with flexibility, Edgar, and that's going to be a very important issue. If you look at secondary locations, if you look at secondary shopping centers, if you look at a lot of places. I mean, from a regulation point of view, the line was always, how do we, regulate organized expansion? And of course, on a lot of those kind of locations, the issue is going to be, how do we regulate change? How do we regulate compression? What do we do, for instance, on secondary locations with places which are maybe not needed for retail anymore, but still need to have a new future? And I think urban planning in that sense, it's going to be a lot about facilitating, let's say, the shift in landscape we are going to see, also, possibly from retail to non-retail. For instance, new retail places coming up, that we facilitate from a spatial point of view the dynamics we see in the trade and we see in the society. And I think from an urban regulation point of view, urban planning point of view, it's a major shift in mindset we will need to see in the coming years.
And do you think that therefore is going to be more mixed? I mean, it was interesting. I was in Warsaw last week looking at some of the development projects. And sorry, I've forgotten the name of it because it also has a vodka factory in it, and that may be the reason for me forgetting the name of it. But that is an interesting mixed use, retail, entertainment, bars, F&B space. Is that the way that things are moving in your view towards this kind of mixed use that Herman was talking about, really?
I think that is mainly interesting for developers because it's much easier for them to, so to say, make this development. If they have a retail component, restaurants, some residential offices, and so on, it's basically easier for them to commercialize this and then sell per unit. But from the investment point of view, it's extremely difficult because we have very few players which can really work and understand and put the kind of evaluation on the retail and residential and everything. This really mixed product. If you are a retail investor, you don't want to have a residential on top of your retail components or the offices. And the same is with when we talk to the purely office investors, sorry to say, but most of them, they have no clue about retail. So it's like, okay, we have to have it because we have a ground floor of the office building, and that's it. It's some kind of must-have, and it's basically they generate significant actually NOI, maybe not significant, but actually they benefit. So they have to have it, but it's not that they would love to invest and develop a mixed-use product. So for developers, I think it's a new niche, and that we're gonna see it much more. But on the investment side, I think we need to learn a lot, basically globally, how to buy this kind of product and operate later on.
Let's just pick some key things that you think investors need to consider when they're looking to invest at the moment. So, quick fire, this is for anybody. What are the key things that investors should be looking at now?
Well, I think for me, and it's something that we've been touching upon, which is really the certainty of your NOI. And what's going to happen 3 years, 5 years down the line, especially if even if you're a medium to long-term holder, you're going to need the liquidity at some point, or you're going to need to refinance at some point. And so to understand where your NOI is going to come from and who are the occupiers and the brands that are going to be driving that's certainly key, I think. Okay, good. Anybody else want to pick that up?
Well, I fully agree. In addition, I would say flexibility. What are the possibilities as an investor? You have to maneuver functions, change functions in the building, mix functions, and react on market trends, which are accelerating in speed.
Okay, good. I've got a last question that I always ask in these, just to try and make it a bit. Let's assume it's time to invest. So I'm now ready to give all of my money to you. And Lord knows there's not much, but I am happy to give it all to you. Where do you think, I guess looking at the strategies that you're looking at, the market that you're seeing, where do you think, and you can pick across Europe, you can pick different sectors, where do you think the most attractive returns are going to be? Let's say I've got quite patient money, I'm happy to wait 10 years.
I can respond to that. I think at the moment what's really popular is what we said, supermarkets, convenience stores. Reason why it's long leases, food anchored, customers, catchments, all tick all boxes. Overall, what you shouldn't invest in is the big shopping centers. Those one we have from 18 to 100,000 square meters. We're pretty old, and there are so many of them. That's one you should avoid at the moment.
Okay, good, Vanessa.
Well, I'm definitely going to raise the card of the outlet sector, of course, because I do believe that even if it's a niche market, but it's a defensive market, and also a market where we are still going to see growth, and where I think we are at the forefront in terms of the management strategies that we're deploying to get those sales and those customers through the door.
Okay, Herman.
Well, what I've liked, what I heard from Edgar and Vanessa, personally, I like a lot. So I shouldn't duplicate those. But of course, you know, we like very much core cities, capital cities, core locations. But okay, those prices are higher than that ceiling. So of course, if your money is really patient, then that's a good target. What I also personally like a lot is, let's say, exploring those core cities, those capital cities, the strong areas. What are the upcoming areas? Where are the gentrifications? Where are the brownfields being regenerated? And basically linking on those new developments, linking on those new transport connections, and capitalizing, like, you know, Coal Drop Yard in London is a famous example. We are working on Borough Yard in London, but in all the core capital cities, you see places like that. That's what I would try to tackle.
Okay, good. Dariusz.
Well, definitely a single tenant long lease. This is, I would say bad, and mixed use locations. Actually, that's because they're the only ones really prepared for the future.